to end at 12:15, so I hope we'll have some time for questions.
Sure. Thanks very much. Two things that I learned today is, one, I should have worn a skirt, and two, you know, when they name you emeritus trustee, that means you're old. So that, you know, when you get off the active board, that's how they get you off. They say, "Oh, you're an emeritus trustee," and you say, "Yeah, it's because I'm old." Our Pennsylvania Real Estate Investment Trust was one, as Mark said, was one of the first, and that's the law was written in 1960, and the trusts were formed really to give the small investor an opportunity to invest in real estate. And when the trust started in 1960, they were not allowed to manage their own real estate. They were essentially a funding source for developers and operators of real estate, and that's the way it remained until 1990, when the new law was passed that changed the ability for REITs to self-manage. And that's when you really saw the explosion of publicly traded REITs, because a lot of real estate companies that were management companies didn't really see the advantage of becoming a public company, because they weren't allowed to manage the real estate that they owned. But with the advent of the law in 1990, publicly traded REITs do manage their own real estate. What I'm going to talk about today relates a lot to the presentation that you had in the beginning, but I'm going to focus on retail because that's what our REIT is. Wall Street, in their sometimes brilliance, likes to see REITs single-focused. Our REIT used to own multifamily, some office, and some retail. But with a little persuasion from Wall Street analysts, we sold all of our other assets and became strictly a retail REIT in 1997. And in 2003, we finished off and sold all of our assets that weren't retail, so that we now have, I think, 38 shopping malls and 7 or 8 what I'll call big box centers, and I'll talk a little bit about both of them. And what I wanted to do today is focus on the shopping mall industry, because all of you are familiar with shopping malls. We own right here in Lehigh Valley Mall. We have Phillipsburg Mall on the other side of the river, and we have Palmer Park Mall right here in Easton. So the mall business was really in the process of a transformation, and while it was transforming, a lot of things happened, and I'm going to go through all the things that happened in the industry, why I call it the perfect storm for the retail, for the shopping mall business, and what we think as a company where it's going to wind up. And the first part that I'm going to talk about is the decline of the full line department stores. If you go back to the first malls that were built and the way the industry grew through the 70s and 80s and about halfway through the 90s, shopping malls were the construction and development of shopping malls was really driven by the growth of the department store industry. And it was your typical real estate, deal where you would have 2 or 3 or 4 department stores, and then as a real estate company, you would lease the stores that were the smaller stores that were in the mall. Generally, the department stores owned their own real estate. The developer would buy the piece of ground, the big piece of ground, and do all the development work, and then sell a pad to a department store. And usually, department stores, there were usually 2 conventional department stores and then a Sears or a Macy's, and that's the way the industry really grew. And the profitability for the department stores was really dependent upon the number of department stores that were in their trade area. And if they could keep two dominant department stores in an area and keep the other ones out, conventional stores, they usually were pretty profitable. And the industry grew. Malls were built, all over the country. And typically, as I said, the conventional department stores, you can see the names in Philadelphia, the Wanamaker's and Strawbridge's and Filene's and G. Fox, and in Texas it was Foley's, and all these stores, as they expanded, and Sears and Penney's expanded, the industry grew. Macy's, which was founded in 1858, started to grow out of New York City and become a consolidator early on. In 1994, Macy's merged with Federated Department Store, which was at that time the largest department store company in the country out of Cincinnati, Ohio, and they began the process of changing all the stores that they owned in the new company to Macy's. The other large consolidator was the May Company. And really the basic difference between the May Company, which came out of St. Louis, and Federated, was the May Company, when they bought a department store, their strategy was to leave the name the same. So when they bought Strawbridge's in Philadelphia, it stayed as a Strawbridge and Clothier. And the same with the stores that they owned, Famous Bar, or any stores that they owned around the country. And you can see today that the number of department stores, and this is pretty comprehensive. There's a few other ones around, but if you look at the list of department stores today, you see there's some regional players, and from a national standpoint, not that many. You have a lot of specialty stores, Neiman Marcus and Nordstrom's and Saks and Lord and Taylor. But when you compare this to the number of department stores that existed in the 1990s, you can see what's happened to the mall industry. And as a result, there are almost no malls being built today because there's almost no department store expansion. What happened was, and I'll use Philadelphia as an example, and actually you can use Lehigh Valley Mall as an example. Lehigh Valley Mall had a Macy's when it was built, and then it had a Wanamaker's as the other conventional department store, and a J.C. Penney. When the May Company and Federated wound up owning Wanamaker's. They had two stores in that mall, the old Wanamaker's building and the Macy's, so they closed one of them down. And that's typically what happened throughout the whole industry, and that's where you saw the malls with vacant anchors, which really affects the traffic in a mall. Because if the whole idea of the department store and the mall was that people would leave the department store and walk through the mall, and that would encourage the shopping in the other stores. When you have a vacant anchor down at the end of the mall, it really limits people's eye. They see a dark anchor at the end of the mall. Most of the time, they won't walk down there. So that's the one part of the perfect storm that hit the mall industry and the retail industry. The second part is what I call the rise of box retailing. And in 1962, as you can see, Walmart, Target, and Kmart opened their first store. A lot of people, don't realize how the three companies actually all got started at the same time. And interestingly enough, the Walmart has had such a dynamic effect on the whole retail industry that in many cases, in small towns, a Walmart store itself will do more volume than a whole mall. And the reason they were able to do that is because Walmart, from this little town of Bentonville, Arkansas, where everybody called Sam Walton Mr. Sam, was light years ahead of everybody else in computerization and digital handling of their distribution and their inventory. Somebody from the May Company told me that when they studied Walmart to see how they could fight the competition, their back of the house, their G&A cost, their home office cost, their buying cost, their advertising cost, distribution for May Company, which at that time was the best in the conventional department store industry, ran about 32%. Walmart was around 18%. So they were able to keep their prices so much lower and just really impact the sales of the conventional department stores. The other thing that grew with the Walmart and the Targets and the Kmart was, some people referred to them as category killers or big boxes. You can see, and you'll recognize all the names on this list, they really took departments out of the old department stores. I thought it was great when you said that I started on the board before most of these kids were born, so I don't know how far back you go in the department store industry, but the old full-line department stores used to carry, most of the goods that are shown on here. And with the growth in the big box or the category killer, those categories disappeared from the conventional department store, because people, if they could go directly to these stores and buy what they wanted.
George, could I ask,
sure.
Did Walmart ever experiment a little bit? I mean, now they won't be part of a mall. Right?
Well,
they ever tried that?
You actually do go into malls, usually not when the mall is built. usually when the mall is built and they want to get into an area, there's so much opposition many times to Walmart coming into a market because of their price competition, and so the way they can get in is if they can get into an existing mall and they'll build their store. But Walmart doesn't really help a mall, because the Walmart shopper tends to just go into the Walmart and out of the Walmart. There's no cross shopping. So, you know, the conventional department stores, this is another shot in this perfect storm, and to the conventional department stores, they struggled. They're still struggling. Macy's is now starting to come back up. They really had a hard time trying to define what their image was going to be, because when they took over all these department stores in all different parts of the country, they had smaller stores than they were ever used to, and all of a sudden they had to sell in small towns that they would have never gone into in most cases with smaller stores. The inline, we talk about the inline department stores that are in the mall. The category killers, or these big boxes, have such tremendous buying power because of their size and the amount of inventory they're buying in a specific area, that it's really hard for the specialty retailers to compete with them. And from a real estate standpoint, when a smaller store in a mall, their occupancy costs, they pay a rent, they pay a percentage rent depending upon if they do sales over a certain point. They pay the real estate taxes. They pay what's called the common area cost. So all the costs to maintain a mall, the air conditioning, the housekeeping, the security, all those costs get divided up on the small stores in the mall. And that raises their cost of occupancy, which is all tied to the amount of sales they can do. So obviously when their sales are impacted by these big category killers, they can't pay the occupancy costs. And so in the industry, when the industry started to make this sea change, we lost a lot of the small stores that were in the malls because they just couldn't do the sales to support the rent. And so you had the vacancies created again by the competition of the big box and category killers. Now, where the smaller stores can do the sales are what we call like more regional, much more successful malls. Right here in Lehigh Valley Mall has very strong sales on a per square foot basis. So the stores stay pretty well occupied. If you go over to Phillipsburg Mall on the other side, that's a perfect example of what I'm talking about. There's real difficulty competing. The middle market malls in smaller areas have a real difficult time keeping the inline stores leased because retailers are not expanding in these middle market malls. They'll go into Lehigh Valley Mall, but not a Phillipsburg or Palmer Park. One of the other legs of this perfect storm is what's called a lifestyle center, which started to pop up maybe 10 years ago. And that is, there's really no definition of a lifestyle center. But in Lehigh Valley, as an example, you have the shops at Saucon Valley, if any of you have gone They're over in Allentown. They're outdoor. They're not enclosed. They're very attractive, architecturally designed, and they attract a lot of the same retailers that malls like to attract, the Ann Taylors, the Gaps, Victoria's Secret, and a lot of restaurants. They really, lifestyle centers were the first ones to really push on the food aspect of the mall. And actually, if you go to Lehigh Valley Mall, in order to fight off some of the competition, we built a lifestyle center in the front of Lehigh Valley Mall. So you can see the freestanding stores in the front. That's actually what, you know, the industry refers to as lifestyle centers. Now, one of the advantages that lifestyle centers had over a big regional mall is they were smaller, and as a result, they could go inboard. They could fit in a community on a smaller piece of land, and they could really rob the sales that were going out to a regional shopping center. So that's another impact on the shopping mall industry.
Do they have, I hate to keep interrupting, but are the overhead costs lower on those also?
Actually, they're not. The only cost that they avoid, as opposed to a mall, is they're not enclosed, so they don't have the heating and air conditioning cost. But other than that, they're essentially the same. You got to security is the same, and maintenance and snow removal and all the things that insurance that cost you a lot of money. I think we talked about most of the things on this one. Another impact on the mall industry, of course, is the rise of internet retailing. Now, if you talk to most retailers, they'll tell you that they just see internet retailing as another sales line for them. It's just another source of business for them that's over and above their existing business. But in fact, it really has had internet retailing has had a tremendous impact on hard goods, what I'll call it. You know, many of you saw the Borders went into chapter 11 this week. Don't know what their survival prognosticators are saying. That they may not make it. Circuit City went out of business. Those type of products you can buy on the internet. You don't have to go to a store. Soft goods, which is really what department stores have come down to, and really what malls have, for the most part, come down to, have not been impacted nearly as much, because there still is this want of a shopper to go either try something on or go through a rack and touch it, as opposed to knowing that you can buy something over the internet as hard goods or sporting goods. I think I keep Cabela's in business. They send me emails every single day, and I wind up buying something. I got more Cabela stuff than I could ever use. So we talked about that, and of course, as software and has become easier, the companies are can keep up with everything so quickly. It just really makes the whole package very available and very easy to use. And then, of course, the final part of the meltdown in the retail industry was the economy. So as all these things were changing in the mall business and the retail business, you had the economy hit, which I've been in the business since 1970. I got out of the Army in December of 1970. I went to work for our company in January of 1970, and I've been through a lot of cycles, but this one was by far the deepest. And it wasn't only that the economy went down. I hate to use buzzwords, but I'll use this one, is the whole paradigm of the shopping center changed. And the mall industry, as I said, I don't think this year there are any malls being built in the U.S., and I think last year there might have been one or two. It's the whole industry has changed, and it's really kind of focused down into the big regional centers, which are still profitable and still do well. It's the small town centers that have to sort of reinvent themselves. And what I'll just show you some pictures of some of our malls and what we're doing. We're bringing in healthcare. We're bringing in a lot of restaurants, bringing in a lot of movie theaters, just all kinds of different uses. Because, pardon me, the one thing about malls is they tend to be at Main and Main. They're at the 100% location, regional location for a town, and in most cases in these smaller towns they're the biggest taxpayer and one of the biggest employers. So you just have to figure out another use for the real estate. Let's see where we can go from here. And you can see all the different uses, and I'll show you some pictures. We took one mall and we knocked down half of it in New Jersey and made the other half into multifamily and office space. In one mall, Plymouth Meeting, which is down at the bottom of the Northeast Extension, it has 90 million cars a year go by that location. But for a long time we weren't getting any of them because they would go right on by and go to King of Prussia Mall, which was, not that much farther away. But what we've done to revitalize that is to bring in a lot of restaurants. Whole Foods we brought into Plymouth Meeting. There was, way back in one of the first malls that was built, the beautiful mall outside of Toronto called Scarborough Town Center. They put a supermarket in that mall when it was built in, I think, like 1971, 72. And everybody thought that was wonderful, but then they said, well, supermarkets don't belong in malls because there's no cross-shopping. Somebody goes into a supermarket, they're not going to walk into the mall to buy. So most companies just never did it for years. But now people see the value of just bringing people to your center, creating traffic, and getting them in the habit. It's very difficult to change people's shopping habits. Very difficult. You have to present something new. In Cherry Hill Mall, the renovation that we did there was to make it a big super regional, and brought in a Nordstrom's and Urban Outfitters, and these are just some pictures. Plymouth Meeting, I just want to get to some of these aerials. P.F. Chang's, there was a joke in the shopping center industry that everybody would say, well, I'm building a lifestyle center, and everybody said, well, what's a lifestyle center? And it got down to be, well, anything that had a P.F. Chang's was a lifestyle center, because they just showed up all over the place. Let me see. Okay, so here you can see in in Cherry Hill, what we did to revitalize that center is we brought a Nordstrom's in and then a whole bunch of restaurants along the front. And that has really driven sales in the mall. Sales have increased, almost 20% per square foot in that center. In Plymouth Meeting, we built this, quasi-lifestyle center anchored by Whole Foods on one side, and then again a whole bunch of restaurants on the other side, and Dave and Buster's entertainment. And then in this center, Voorhees Town Center, which we really were forced to buy when we bought a whole group of malls from the Rouse Company in Baltimore. We knocked down half of it, and where you see down at this end the boulevard, and that's all multifamily that we built, and office space, and are going to wind up with probably 1/4 of the retail space that what the mall was originally, as the mall was originally built. So, what time is the class over?
12:15.
Oh, so we have good time if you have any questions.
Let me throw one out.
Okay.
The guys mentioned that, and you mentioned too, it is tied to the economy and the REIT's performance, but it used to be that there was a little bit of either a lag or lead, so there was still some kind of advantage of investing in a REIT, say, as an asset class, to get a little bit of diversification on that. Is that still the case?
Oh yeah, absolutely. The sales are starting to come back. In all of our retail centers, which is a good sign because when people start spending money, that means people are going back to work, and that's really what drives the commercial real estate market. They all have. They've all suffered, from the economy, but in different ways. There's office rents have declined in a lot of cases. They're starting to stabilize. Our sales at the trough were down to about $300 and I think $25 a square foot, and they're now up to I think $365 a square foot. So they've come back, about 10% or more in the last year. There's a lot of REITs that specialize in supermarket anchored centers. All the REITs were the price of the stock. Our stock went from a high of 50 down to a low of 2, believe it or not. And it's back up to around, I think, 14 now or some. And all the REITs are, starting to come back. Some of them are actually back already to where they were. Some of the bigger ones, Simon, which is the biggest property REIT in the shopping center industry out of Indianapolis, their stock is back to where it was pre-depression, I'll call it. So it's still a good investment to get into.
You were saying that the shopping malls have pretty much halted and new ones being built. And I feel like, at least at home, I feel like the lifestyle centers, you said, there's really no definition, but I can think of like 5 or 6 that the way you described it, I would consider them a lifestyle center.
Right.
Is this like is this ever going to replace malls, do you think, or is it just going to be a supplement to them? Or
yeah, it's as I said, you can fit a lifestyle center in a smaller piece of land, so that's the advantage to it. The disadvantage that lifestyle centers have, I gave a talk to a real estate group about 2 months ago. It was in a real estate appraisers and bankers. And one of the interesting things about a lifestyle center, when you build a mall, your lease for the small stores said that you had Macy's on one end and you had Strawbridge and Clothier on the other end, and you had Sears. And that was what you guaranteed for the tenant in the lease. And it said, if you lost any one of those anchors, that there would be certain implications in the lease if you did not replace that anchor, usually within a year. So if you didn't replace the anchor, maybe the tenant would have a reduced rent, or it would have some other impact on the lease. When lifestyle centers started, the industry started, they had these co-tenancy clauses, but they didn't have anchors. Many of them were built without anchors. So it was sort of like a group of retailers, a herd, and they'd say, Ann Taylor, you're going into that lifestyle center. And they'd say to the developer, I'll go in if Ann Taylor's in that center. Or I'll go in if Urban Outfitters is in that center. And that's what my occupancy depends on. When Ann Taylor's business started to go south, they lost an Ann Taylor, they lost all their stores. And so when I went to this, and gave this talk about a month ago or 2 months ago, I had all these people come up to me and say, like, what are you doing about your co-tenancy clauses? Because when the market crashed, there was a lot of mortgagees that had lent money to developers to build these centers, and the centers were going dark for most part because they were losing their tenants on these co-tenancy clauses. But a good lifestyle center in a good location hurts. They're not going to ever replace them all, but they obviously hurt the sales in them all. Yes?
How did you get started in retail or in the real estate industry?
I was born into it. My father started a company back in 1929, of all years to start a company, and he, and my brother joined in the I guess in the late 50s, and I joined it when I came out of the Army in 1970. So, and my background was, as Mark stated, I was a civil engineer, and I was interested in the construction part, and that's really how I got into it, managing the construction of things that we developed.
Why do chain restaurants always seem to locate in malls? And why do they do so well? A restaurant that doesn't have as many locations.
Why are chains always in malls? Chains?
Yeah, like chain restaurants.
The PF Chang's.
Oh, PF Chang's. Money. The restaurant deals are very expensive deals. They know, restaurants know that they have become real anchors to centers, and in a lot of cases replace the department stores in terms of the amount of traffic they bring, and so they demand big dollars to come into your location, and malls tend to be big operating businesses with cash and money, so you can afford to give them the tenant allowances that they require. They do big volumes, and they bring a lot of people to the centers.
Just so this is contracting. I mean, some of them must get pretty complicated. I mean, the level of detail in contracts. But
oh yes.
You mentioned some of that. But is there a sort of an optimal length of the contract? I mean, it could be too long. I mean, if you're worried about a restaurant all of a sudden that goes out of fashion.
Yeah, I tell people, and I say it to our company. When I started in the business, shopping mall business was a real estate business. You'd own a property and you'd rent the property out. Okay? It's not a real estate business anymore in that fashion. It's more like a hotel management company. We have 700, I think, employees now in Pre, and all involved in management. It's marketing intensive. You need to do demographics constantly and market, just figure out how to market your centers. It's security. And you're constantly looking for the best tenants to draw people in. So the leasing is very, very intense. And it's much more of a management style business than it was when I first broke into it. Yes?
I know you mentioned how the internet was affecting a lot of stores, but the internet, one would assume, is just going to get better and be able to virtually try things on. Do you think with like the internet and where technology is going that malls are going to be viable in 20 to 30 years, or is it too far?
Okay. Let's see, I'm 68, so in 30 years I don't care. But I don't know, it's a good question. The one thing that you talk to most retailers and they'll tell you that brick and mortar will always be a part of their sales. And again, as I said, it could be, and I was joking about Cabela's. Cabela's is a good example. Cabela's has one store that covers, you know, Lord knows how many miles, right? That's their brick and mortar advertising. But, you know, people buy most of the stuff over the internet. But they do have that brick and mortar presence. And women who are the predominant shoppers in shopping malls still like to go into the mall and for soft goods, for clothing, or go to a store for clothing, I should say. Sometimes they'll go to the store and they'll see what they want and they'll go back, and people will go back and order it on the internet. But that still, you know, makes the store valuable. Now, what it will do is reduce the number of stores that, you know, that a retailer will take. And they'll limit themselves, for the malls that we own in the Lehigh Valley, they'll limit themselves to Lehigh Valley Mall. So it'll become more and more difficult to lease Phillipsburg, and that's why you have to find these other uses.